amid escalating South China Sea tensions. Surprising U.S.-China trade thaw signals emerge while global inflation pressures and American household costs surge. How will these changes reshape the daily lives of millions of Americans? Tensions in the South China Sea have intensified as China escalates assertive activities, including deploying water cannons, military-grade lasers, and ramming Philippine vessels, according to Reuters. Beijing has militarized 7 artificial islands, equipping them with radars, missile systems, and military airfields, forming a control triangle over key sea lanes. The South China Sea handles approximately 1/3 of global maritime trade and contains an estimated 11 billion barrels of oil and 190 trillion cubic feet of natural gas based on U.S. Energy Information Administration data. Despite the 2016 Hague Tribunal ruling invalidating China's 9 Line claims, Beijing continues its expansive activities. Neighboring countries like the Philippines, Vietnam, Malaysia, and Indonesia are bolstering defenses with strategic support from the US, Japan, India, and Australia. Increased regional militarization raises the risk of full-scale confrontations, potentially disrupting critical trade routes essential to global and American supply chains. While South China Sea tensions rise, signs of easing in the US-China trade conflict are emerging. Beijing is considering removing tariffs of up to 125% on U.S. goods, particularly medical equipment and industrial chemicals, to mitigate domestic economic strain. Additionally, China announced new emergency contingency plans to counter external shocks, signaling cautious recalibration. In Washington, senior officials, including Treasury Secretary Janet Yellen, acknowledged that complete economic decoupling from China is unrealistic, hinting at a more negotiation-driven approach. According to CNBC, analysts warn that prolonged trade disputes would severely harm both nations' economies, increasing pressure on policymakers to seek compromise. For American consumers, a trade de-escalation could stabilize the prices of imported goods, from electronics to pharmaceuticals, easing some of the inflationary pressures currently burdening U.S. households. Global supply chain disruptions and rising transportation costs have pushed up fuel, food, and consumer goods prices worldwide. According to the Financial Times, inflationary pressures have strained major economies across the U.S., Europe, and East Asia, fueling fears of recession and declining investment. In the U.S., the impacts are sharply felt. Household living costs are projected to rise by an average of $1,243 per year in 2025 due to new tariffs, the highest annual tax increase since 1993. The Peterson Institute for International Economics estimated consumer confidence has plummeted 32% since January 2025, reaching its lowest level since 1990. As reported by the University of Michigan's Consumer Sentiment Index supply chain, bottlenecks risk causing product shortages, reminiscent of the pandemic era, particularly in sectors reliant on Chinese imports like electronics, apparel, and pharmaceuticals. Small businesses responsible for 44% of U.S. GDP and employing 110 million Americans are facing rising costs and disrupted supply lines, heightening risks of order cuts and bankruptcies, according to CNBC. These economic challenges could dampen consumer spending, stall job creation, and increase financial stress for American households in the coming months. The trade war between the United States and China is intensifying through tariffs and international lawsuits. It's directly impacting the U.S. economy and the everyday lives of American families. How will this rising tension shape the future of American families? In a sharp escalation of trade tensions, China issued a stern warning on April 21st, vowing retaliation against any country aligning with the U.S. in isolating Beijing through tariff exemptions. Chinese Ministry of Commerce spokesperson He Yadong emphasized any move damaging China's core interests will be met with reciprocal countermeasures. This comes after former President Donald Trump promised a 60% blanket tariff on all Chinese imports. If re-elected analysts warn this tit-for-tat escalation could have serious consequences for U.S. consumers. According to a 2024 Peterson Institute report, Trump's earlier tariffs led to a $1,277 annual cost increase per household. Higher prices on Chinese goods from electronics to household items will hit low and middle-income Americans the hardest. And that's not all. Disruptions in global supply chains may deter foreign investment and shift manufacturing bases away from the U.S. The result: threats to job security and wage growth, especially in key industrial states like Michigan and Ohio. On April 19th, the U.S. government imposed a staggering 245% tariff on select Chinese steel and aluminum products, escalating the trade war to new heights. In response, China filed a formal complaint with the World Trade Organization on April 22nd and appointed Vice Minister Li Cheng as the new lead trade negotiator and official WTO representative. Experts warn these soaring tariffs will raise costs across sectors dependent on Chinese imports, especially construction, automotive, and electronics. According to the U.S. Chamber of Commerce, such tariffs could reduce GDP by 0.6% and eliminate up to 320,000 jobs by mid-2026. For ordinary Americans, it means higher prices and shrinking job opportunities. Small manufacturers may struggle with rising input costs, while financial markets could face increased volatility, impacting 401k, retirement plans, and household investments. Chinese President Xi Jinping completed a high-profile diplomatic tour across Vietnam, Malaysia, and Cambodia from April 14th to 20, urging the formation of a regional coalition to counter what he described as unilateral tariff bullying by the U.S. During the visit, China signed 16 bilateral trade agreements and pledged $11.5 billion in infrastructure investments. Southeast Asia has now overtaken the U.S. as China's top regional trading partner, with $987 billion in total trade in 2024, compared to just $660 billion with the U.S. Analysts say this realignment could marginalize U.S. exporters and investors. For American farmers, factory workers, and small exporters, especially those reliant on Asian markets, this poses a direct threat. With China steering trade deals toward regional partners, the U.S. risks exclusion from lucrative supply chains, weakening America's global economic influence and reducing domestic job creation. The U.S. disrupts supply chains and raises risk of global recession. The United States is increasing pressure on countries to choose sides between Washington and Beijing, particularly in the high-tech sector. Could the U.S.-China tech confrontation pull the entire world into a new economic downturn? The United States is advancing a strategy aimed at distancing China from the global supply chain, particularly in the high-tech sector. The Washington administration has expanded export control measures, not only applying them to American companies, but also requiring foreign firms to choose between cooperating exclusively with the U.S. or with China. According to Bloomberg, the U.S. has imposed an additional 20% tariff on a wide range of Chinese products and has further extended its chip export restrictions. The restrictions on chip exports to China have also resulted in significant losses for American businesses and their global partners. According to Bloomberg, October 2024, NVIDIA is expected to lose $5.5 billion in revenue due to its inability to sell advanced AI chips to China, an amount equivalent to roughly 20% of its projected 2025 revenue. ASML, Netherlands, the world's leading manufacturer of chip printing machines, has warned that its revenue from the Chinese market could decline from nearly 50% to just 20% by 2025. Companies such as Tokyo Electron, Japan, and Samsung, South Korea, face similar risks. Disruptions in the global chip supply chain are likely to drive up the prices of consumer technology products, such as smartphones, laptops, and electric vehicles, due to increased production costs. Furthermore, if companies are forced to reduce investment and cut jobs to offset losses, the risk of rising unemployment in the tech sector will grow. The impact of the US-China competition, combined with rising protectionist policies, is fueling concerns about a potential global recession. According to an end-of-year 2024 report by the International Monetary Fund (IMF), the risk of a global economic downturn in 2025 stands at 30%, more than double the level recorded the previous year. In December 2024, the European Central Bank, ECB, announced it would continue to lower interest rates, following a drop in Eurozone inflation to 2.4%, the lowest level in nearly 2 years. As central banks tighten policies to manage risk, businesses may face greater difficulty accessing capital, which could hinder growth and employment. In the United States, the Federal Reserve has maintained a cautious policy stance, while consumers are increasingly tightening their spending. This reflects mounting pressure on everyday life, with persistently high prices for essentials such as food, energy, and loan interest rates for home and auto purchases. According to a survey by the Conference Board, U.S. consumer confidence dropped by 9 points in the fourth quarter of 2024, driven by concerns over prolonged inflation and rising living costs. In November 2024, former President Donald Trump announced that he would replace Federal Reserve Chairman Jerome Powell if reelected, stating that Powell does not support his economic policies. This statement has raised concerns in financial markets about the potential loss of the Fed's independence, an essential factor in maintaining monetary stability. At present, the Fed has no stated plans to intervene should a market crisis occur, raising questions about its ability to respond effectively in times of major economic volatility. Since late 2024, foreign investors have begun withdrawing from U.S. government bonds. Meanwhile, gold prices have risen by 14% in just 3 months, signaling a growing trend toward risk aversion. For American households, this environment means higher mortgage and consumer loan interest rates, while a weakening U.S. dollar is driving up the cost of imported goods. If the Fed were to lose its independence, monetary policy could become more susceptible to political influence, directly impacting consumer spending, price stability, and employment opportunities. The United States has imposed record-high tariffs on Chinese goods, but the question remains, which side stands to lose more? While China responds with currency devaluation and redirects its exports, the world now faces the risk of deepening divisions. In the first quarter of 2025, the administration of President Trump imposed record-high tariffs, with some products reaching as high as 145% on imports from China, aiming to reduce dependency and pressure Beijing to make concessions on trade and technology. According to AP News, however, but as import costs rose rapidly, many small American businesses were forced to raise prices, cut staff, or withdraw from the market. A retail company in California reported having to pay nearly $630,000 more per year due to the new tariffs. A coffee machine that used to cost $120 has now risen to over $180. This has caused consumers to become more cautious in their daily spending. The ripple effect has also placed the Federal Reserve, the Fed, in a difficult position. If it maintains high interest rates to contain inflation, it risks stifling growth. But if it lowers rates to stimulate demand, it puts pressure on the U.S. dollar. By the end of March 2025, the Consumer Price Index, the CPI, had risen by 4.2% compared to the same period last year. the highest in 18 months. In this context, households with young children or elderly members are especially affected, as healthcare and food costs have surged. Immediately following the United States' decision to raise tariffs on Chinese goods to as high as 145%, Beijing allowed the renminbi to depreciate significantly. This devaluation made Chinese exports more affordable in global markets. According to a report from Bloomberg, in April 2025, the RMB USD exchange rate dropped to 7.4290, the weakest level since 2010. However, Chinese consumers are now experiencing price increases of 10 to 20% on imported goods compared to the beginning of the year. Many households have begun to shift their preference toward domestic products. At the same time, China swiftly restructured its export strategy, redirecting a large share toward ASEAN and Europe. According to Global Times, in the first quarter of 2025, exports to ASEAN rose by 20.3%, especially in categories such as lithium batteries, auto parts, and consumer electronics. As for Europe, the World Trade Organization, the WTO, projects that Chinese exports to the region could increase by an additional 4 to 9% in 2025. One outcome of this shift is that many Chinese workers are now required to retrain and acquire new skills in order to adapt to changes in production lines, which may temporarily disrupt their incomes. According to AP News, in the first quarter of 2025, China's GDP grew by 5.4%, exceeding the projected 5.1%, largely due to a surge in exports prior to the implementation of new U.S. tariffs. Nevertheless, falling real estate prices and a 9.9% decline in property sector investment have raised concerns among many households. Asset values have dropped, and low inflation has contributed to a slowdown in the domestic consumption, although exports increased by 6.9%, enabling China to post a trade surplus of 1.96 trillion yuan in the first quarter. A 6% drop in imports has led many families to reduce their purchases of imported goods. In April 2025, the US dollar fell nearly 10% from its peak earlier in the year, marking its sharpest decline since 2022. The USD index dropped below the 100-point threshold, reflecting a weakening of global confidence in the dollar. Prices for imported goods, such as electronics and food, have risen. In addition, interest rates on home and consumer loans have also increased, making everyday living costs more burdensome. President Trump's trade and diplomatic policies are contributing to a growing divide between the United States. Global markets have been thrown into turbulence following the United States' confirmation of a 145% tariff on Chinese goods. At the same time, China, the European Union, and international investors are simultaneously launching strategic responses. What exactly is unfolding behind the figures? On April 11, 2025, several Asian stock markets recorded significant declines. Japan's Nikkei 225 index closed down nearly 4%, while South Korea's Kospi index fell by more than 2.5% during the morning session, according to data from Bloomberg and Reuters. On April 10th, the President of the United States announced a temporary suspension of certain additional tariffs for a period of 90 days. This pause in tariff implementation was expected to provide an opportunity to resume U.S.-China trade negotiations. However, shortly thereafter, the White House confirmed that the total tariffs currently applied to Chinese goods have reached 145%, raising concerns about the intensity of economic tensions between the two countries. Beijing was quick to reaffirm that it has prepared a series of carefully considered countermeasures. One of the most heavily affected sectors is agriculture, particularly soybeans, a commodity China imports in large quantities for animal feed production. According to the United States Department of Agriculture, USDA, China was once the destination for over 25% of U.S. soybean exports prior to 2018. Following earlier rounds of tariffs, American soybean exports to China experienced a significant decline. On Chinese social media platforms, public reactions indicate a heightened sense of national pride. Online communities strongly criticized offensive commentary, while calling for greater support of domestic products. This effort is expected to strengthen Beijing's position in upcoming negotiations. On April 11, 2025, U.S. President Donald Trump expressed appreciation for the European Union's decision to temporarily refrain from implementing retaliatory tariffs on American goods. Speaking at a cabinet meeting, as reported by DW News, he described the EU's move as very smart. The decision from the EU signals a willingness to engage in dialogue and to avoid escalating trade tensions with the United States at a time when both sides are experiencing the effects of global instability. The EU has also confirmed that it will restart trade negotiations, beginning on April 17, 2025. Several scenarios involving soft concessions have been raised, including the possibility that the EU may increase imports of liquefied natural gas, LNG, from the United States. Such a move could help reduce the current U.S. trade deficit with the EU, which stands at approximately $200 billion, according to 2024 data from the Office of the United States Trade Representative. However, significant challenges remain, particularly differences in product standards and internal regulations within the EU. Key areas include food safety standards, industrial chemical regulations, and oversight of digital platforms. According to reports from DW News and Bloomberg, U.S. stock indices declined sharply following a brief recovery, while the yield on the 10-year U.S. Treasury note hovered around 4.3, reflecting growing uncertainty among investors. Notably, major investors have begun shifting towards safer assets, such as gold and foreign government bonds. Demand for U.S. Treasury securities has shown signs of weakening amid reduced purchases by foreign nations and a decline in U.S. dollar reserves. This trend suggests the U.S. government may face higher borrowing costs, which could impact its ability to sustain public spending and maintain economic support packages. At the same time, this shift places pressure on the global financial standing of the United States, potentially weakening its leverage in negotiations, especially in discussions with China and the European Union.